So, it's December, the time for gift giving, whether thoughtful or white elephant. All the Wall Street firms and many news outlets are dutifully gathering up nicely wrapped predictions and estimates of what the market is going to do in 2024. This is true whether we ask them for it or not. I did a simple Google search on 2024 stock market predictions on Friday, December 8th. First glance showed Wall Street analysts at JP Morgan, Fundstrat, and Bank of America with forecasts that range from the S&P closing 2024 at 5,200, which would be a 14% increase, as we're over 4,600 currently on the S&P, to Bank of America's technical strategists forecasting the S&P 500 falling to 3,500. That's over 20%. That would be a technical bear market by mid-year, albeit with potential rebound later. You don't have to look hard to find a professional with a story or prediction that more or less meets your expectations. Confirmation bias, narrative bias, overconfidence. The prediction game and the stock market creates a psychological treasure trove of examples for behavioral science researchers. We call them different versions of predictable disappointments. Why do we consistently unwrap these holiday time stock market predictions? Well, it could be that we just want to know the future. It could also be that we want to take advantage of something and try to get a big win, or in reverse, try to miss something and avoid a big loss. It could also be that we just like to eliminate or reduce uncertainty and risk. The question is, have these gifts of predictions ever really worked out well for us? Or are they more like fruitcake, dense, inedible, only valuable to the person giving them, as opposed to those of us on the receiving end? Before we remind ourselves how suspect market predictions really are, let's start with a quick check of markets year to date. The S&P 500 stock index, the largest U.S. companies, is up almost 20% year to date. The MSCI All Country World Index without U.S. stocks is up over 10.5%, and even bonds, represented by the Bloomberg U.S. Aggregate, are up over 3% now year to date. Based on historical averages, a relatively good year across the board. Because most U.S. stock market forecasts focus on the S&P 500, let's look at where it is currently and compare that to what analysts said just 12 months ago. The S&P 500 opened the year at 3839.50 and closed on December 8th, 2023 at just over 4,600. Now, our friends at Avantis did some research that found that the median estimate from 15 top firms for the 2023 year-end closing value of the S&P 500, that median estimate was 4,100. Now, forecasts and predictions in that group of 15 ranged from a low of 3,400 to a high of 4,750. At the end of November, the S&P was at 4568. The midpoint estimate, that one of 4,100, forecasted a 6.8% total return for the calendar year, well below the historical average of the S&P 500, which is between 9% and 11%. The actual return of the S&P 500, again, through November 30th, was just over 19%. So that median was an underestimation of over 12 percentage points. The experts, for the most part, had a less positive view of 2023 markets than has played out. Of course, we'll see by the end of the year. This miss of the median in 2023 is not unusual. Going back to 2018, Avantis researchers found that the average miss of the midpoint forecast was on average 18% over or under the actual realized return of the S&P 500 in that year. For every year, the median estimate was off by double digits, between 12 and 26 percentage points. What's interesting to me is that the experts as a group have been pretty pessimistic regarding U.S. stocks since 2020. The only year the midpoint estimate was above the long-term historical average of the market was 2019, and that estimate still proved to be a big underestimation of the S&P's ultimate 28.9% return. Because negative news gets reported, you have to wonder if this negative bias reflects some strategy to get attention. In that almost 6-year study, the U.S. stock market was negative for the calendar year twice, and positive, at least through the end of last week, 4 years. Stock market risk, the risk of a loss, is alive and well and largely unpredictable. The median estimates in both negative years, 2018 and 2022, had forecasted a positive year. In that same study, the Avantis team reminded readers that stocks, though quite unpredictable year to year, have still provided high probabilities of positive returns for long-term investors. They show that 75% of all rolling 12-month periods, 1 year, have been positive since 1928. That's 3 out of 4. That number rises to 89% of all 5-year periods, and when you go to 20-year periods, it gets to 100%. The uncertainty of stock market performance really just jumps out at you when you look at those 12-month periods. If you look at those periods, they saw a low 1 year of 44% loss to a high in another year of a 57% gain. That's over 100 percentage points spread between the worst case and best case. The 5-year period's low was a negative 15% annualized to a high of 27% annualized. And then if you go to the 20-year period, that low was a positive 2.7%, so still above zero, with a high of 17.3% annualized. The point here being that investors who are able to stay invested for longer periods have a much higher probability of a positive experience. So, with all that in mind, why should investors resist opening the gifts of year-end stock market predictions, forecasts, or estimations? Well, it could be that they're just continuously incorrect. It's kind of like getting food that doesn't taste good. They also play to our mistaken narratives, kind of these biases that we believe someone really does know the future, when in likelihood, they don't. We may find an estimate that we like, and we like it so well that we are tempted to act on it. And finally, we might forget to just embrace uncertainty as part of the world of stock market investing, and then we might plan poorly for the future in light of that. In October of 2022, Jason Zweig of the Wall Street Journal wrote, "It's precisely at times like these that investors need to be on guard against the next certainty. You don't have to act on every forecast, and the more certain a prediction sounds, the more you should doubt its validity." Times like these, when it comes to the value of market predictions, are really any time. Predictions and forecasts always give the impression of reasonability and high likelihood. I think Zweig would agree that, quote, "the more certain it sounds" is just another way of saying no matter how beautiful the packaging, beware of opening the gift. At Foster Group, we want to wish you a very happy holiday season. We hope that you are able to give and receive some meaningful gifts, especially the gift of time with the people that you love. We'll be off during Christmas week, so our next Financial Perspectives will come out in January of 2024. So Happy New Year in advance. Until then, we hope you keep choosing educated optimism as the antidote for anxious uncertainty, especially regarding financial markets. We'll see you soon.